here. Thank you so much for joining me today, for checking out the channel. Please remember to subscribe below so that you get notifications for all of my new episodes on real estate investing. So again, welcome to the channel, guys. Today's topic is going to be a quick cash flow analysis. Some people call this the napkin method because it's so simple. You can literally scribble it down on a napkin. It's a really good way that if you are just checking out a property or someone calls you and brings you a deal, you can sit, jot down a few numbers, and decide if you even want to delve into it further. If you think about it, as a real estate investor, I probably get close to 20 deals come across my desk per week. If I were to sit and deeply analyze every single one of them, it would be crazy. I would never have enough time. And I need to know where to allocate my resources to properties that are really going to be worth my while. So this is the quick cash flow analysis method. So I'm going to walk you guys through a little example to show you exactly how I would quickly analyze a property to determine whether I even want to pursue investigating it further. Now, cash flow is not everything. You have to consider other factors like the market, like whatever appreciation, things that are going on. I don't want to get into that too deeply because the point of this video is that you need to find a property that is cash flowing from day one. That is a non-negotiable. If you are finding properties that are operating in negative cash flow, that is not a property you should be considering. And I don't want you to take these and start fudging these numbers. Stick to your guns, stick to these percentages and these ratios, and you will never pick a property that fails. As you get more experienced and you're looking for different things out of properties, then you can consider things beyond just cash flow. But if you're just getting started and you want a quick way to successfully analyze a property, stick to these. A lot of investors I know make mistakes because they start to fudge the ratios. Oh, I can tweak a little bit here. Oh, I can take this out here. And it will skew your numbers every single time and you will regret it. So remember that real estate investing has no emotion to it. They're just houses. Don't get stuck on a property just because you really like it and you want to make the numbers work. Just stick to this formula. Keep it very unemotional. If the numbers don't work, they don't work. You move on to the next one. There is always another deal. Okay, guys, I promise you that. So I want to start with that kind of little tidbit because it's important that you don't start to skew these numbers, especially when you're first getting started. It does not need to be cash flowing $600 a month. Even if it's breaking even or making small cash flow, but you intend on making improvements to the property, raising rents, then that's okay. But I highly encourage you to make sure that it is cash flowing. In fact, it is a non-negotiable that it is cash flowing from day one, because that way, no matter what goes wrong with this house, it will be able to carry itself. You don't know what's going to happen in your life. You don't know if you're going to be able to carry this mortgage on your own. Do not make those assumptions. If you know the property can carry itself, you can sleep at night knowing that you'll never have to struggle or worry. So let's go into a quick example. So we're going to assume, because we're in the Toronto area, that we're going to look at a house that is $400,000, which is not super unreasonable. We're going to also consider and just assume that this is a single family home. It's going to make a big difference when it comes to analyzing your numbers. And keep in mind that every single investor is different. Some investors throw in all-inclusive, with utilities and internet so that they can ask a little bit more for rent. That's okay. But just know what your model is. My model, for example, is to have my tenants pay utilities. I don't want to do that. I don't want to worry about their power getting shut off. I don't want to, worry about absorbing all of those costs. The joy and the beauty of single-family investing is that you can pass off hydro, gas, water, all of that off to your tenants. It's much more difficult when you're investing in multifamily to be able to pass those off because there might not be separate meters. You might have inherited tenants that have been paying all-inclusive for years. So I encourage you that if you're going to do single family, that you don't worry about this so much, jacking that up, $500. Worry more about, getting them to take care of these utilities and costs, because you don't want to be responsible if they're doing, their dishwasher 15 times a day and all of the expenses that you can get with really irresponsible tenants. If they're paying their own hydro, they're probably going to be a lot more cautious about turning off the lights. So I'm going to just assume that for wherever we are, maybe we're just not in like a good neighborhood, not in a super awesome market. So rents are only like $2,000. That's not unheard of. This is the one thing about single family homes is apartments and condos are almost outpacing single family rents, which is kind of crazy, but it's just what's happening in the local market. So you can find places where you can rent an entire family home for like under $3,000, but yet rent a condo in downtown Toronto for about the same price. So it all just depends on where you are. We'll just assume like I live in Guelph. I invest, kind of in this area. So let's just say, it's an okay house. You're going to get about $2,000 a month in rent. And you're purchasing this house, you're analyzing it for $400,000. Now, I do a pretty low vacancy. Some people would say 10% is more realistic. In the GTA, I'm not too worried about it. I'm a good property manager. I'm a good landlord. I know how to entice my tenants. I'm pretty confident that a 5% vacancy cost is pretty reasonable. If you are an inexperienced property manager, if you don't know how to really entice high quality tenants, maybe you want to build in a 10% buffer. But considering vacancies are at an all-time low, I would say you're probably pretty safe in the GTA. But if you're really extra conservative, it's okay to bump up that number. You're better off being overly conservative than under conservative. So I'm assuming a 5% vacancy rate. So that means off of this gross rent, I'm taking off $100 just, for those times in between tenants. So now I'm down to $1,900. These are your basic expenses that you need to consider. So insurance. This is a little different than your normal house insurance. It's a little more expensive. They have to, take into consideration that somebody besides you is living in this property. You're going to want a higher premium to cover things like damage and all of those sorts of things. You're going to want to talk to a really good commercial real estate insurance broker that knows how to give you the right policy for your needs as a landlord. You do not want to just get your everyday common, real estate insurance policy that is not going to protect you. You need to go and make sure you get a proper landlording and tenant policy. I would also encourage, I'm going a little off on a tangent, that you get your tenants to carry their own insurance as well. Last time I rented myself personally, they actually required it as part of the lease. And it's a good point because if anything were to get damaged due to like a flood, if someone stole my belongings, things like that, I'm protected and my landlord's also protected too. So it's a good thing to maybe add to your lease. So now these are monthly projections, just so you guys are aware, okay? So $120 a month for insurance isn't unreasonable. Usually you're paying, between $1,000 to $1,500 a year for tenant insurance. For taxes, now that all really depends on what market you're in. Since I'm in Guelph, our taxes are actually quite high in this area. So you're probably looking at close to $200 a month for taxes. And you're going to probably start to see them go up in municipalities as we start to the housing market tightens down, housing is going to continue to get more expensive, you're definitely going to see taxes rise even more. So, again, this can vary. It could be, $100, it could be $120 a month. I'm just speaking from my local market. Now, you'll see that I've left hydro, gas, and water blank. It's because I fully intend on renting this house out without having to cover my own utilities. So I left that out. That's their problem. Property management fees. Now, this all depends, again, on your property management company. I'm assuming industry average, which is about 8%. It could be as high as 10 or 12. It could be as low as 5. You need to decide. I kind of hit somewhere in the middle. I always assume about an 8% PM fee if I'm not managing it myself. That's $150. Then you should also consider condo fees. If you're looking at a townhouse or a condo, keep in mind there's going to be additional fees to that. You can decide whether those condo fees get passed on to the tenant through their rent, or whether you're going to just, include that and pay for it yourself. I also assume about a 5% maintenance fee. These are things like leaky faucets, adding in, maybe energy saving devices, things that need to get done around the house, painting, yard trimming, things like that. A cool point about that is if I'm doing a single family home, I always try to build it into my contract and into the lease that my tenants do the snow removal and the grass cutting as a separate contract. So rather than have to pay a PM to come in or some local neighborhood person, I'm making that their responsibility. Because they're living in an entire house, they also tend to be a little more responsible about that type of upkeep as well. So I'm assuming, about a 5% maintenance fee per month on little, fixes and things like that need to get done. So that's about $100 a month. If you're already doing renovations or buying a house in fairly good condition, you probably don't need to do a ton of maintenance. You might need to replace an appliance here and there, do some touch-up painting or things like that. But for the most part, you should be okay with that type of estimate. So it's not too bad. We're looking at about $570 a month in terms of expenses for a single family home. Definitely decent. Then we have to factor in our debt service ratio. So this is where we have to obviously factor in the mortgage and the other expenses. Now, we're just assuming this is a plain Jane purchase. There's no second mortgages, there's no VTBs, nothing crazy like that. This is a simple purchase. So we're looking at $320,000 mortgage, right? We purchased it for $400,000, 20% down, it's $320,000. We're assuming a 3.5% mortgage rate, which is pretty typical, at a 30-year amortization, 5-year variable. This is kind of like a new thing now. Variable is definitely the way a lot of investors are going for many reasons because of the fluctuating interest rates. And always try to get a 30-year amortization if you can. Obviously, people want to pay it down faster if it's a principal residence, but this will actually help you as an investor in the long run. So all those things factored in, you are looking at $1,432 per month in debt servicing. So when you do this whole analysis, pretty basic, right? You can see how simple this would be to just scribble it on a napkin using a calculator. It's super simple. You're going to take your gross rents, and keep in mind that that encompasses everything. If you have, a property that has a parking lot or you're renting out a garage, you definitely need to include that in the gross rent. You're gonna less your vacancy plus all of these expenses, right? That $570 plus this $1,432 for your debt service. Now, do you know what number you actually get after doing these very conservative estimates? -102. So if I were looking at this property and needed to do a really quick little analysis on it, I would look at that number and say, ooh, that's not too great. If it was -$2, -$50, maybe I'd poke a little deeper into this. But the fact that it's -102 is going to deter me right off the bat. Now, there's a caveat to this and a little bit of an exception that I would say. And that is that $2,000 for rent is pretty low, especially in Guelph. If I was pretty confident that this is a really rundown home and that I was going to pour in a bit of renovations to this, make it really nice, put in a brand new kitchen, maybe add a bathroom, whatever, the property needed, and I knew that I could up this rent to say $2,800, well, that's a different story, because now this becomes, almost $700 in positive cash flow. So it all, you have to take these things with a grain of salt. But obviously, right off the jump, if I'm looking at this and I'm not confident in my market rents, I would, kind of maybe be a little cautious about this. And again, it all depends on your strategy. Me in particular, I always buy undervalued properties. It's my model. I find things off market that are just kind of run down in nice neighborhoods. I pour in some reno budget, I up the rents, make the property great, and then I'm not too worried about this cash flow number, right? But again, it's really good to paint yourself a picture of like, this is your worst case. That $2,000 is your worst case. That means you're not cash flowing. That means that's money coming out of your pocket every single month to make this property like flow and keep going. It's not a nice feeling. But if I know that, hey, I can really up the value of this property and start to ask $2,800 a month, and I'm cash flowing, $600-$700 a month, I might definitely take on the risk. So it's important to understand, are you a forced appreciation type of investor, or are you turnkey? If, for example, this was turnkey and you're in negative 102, do not take this property. I wouldn't even give it a second glance. But if, again, the property's run down, it needs a lot of work, and you're pretty confident that you're going to be able to boost those rents, this number is not too shabby. But keep in mind that once you renovate it, things might go up, like your taxes. If you refi, to pull out some of your rental budget, your mortgage is going to go up. You need to factor those things in. I'm a BRRRR investor: buy, renovate, rent, and refinance. So I always have to be really careful that if I'm going to refinance to pull out my budget, this number may look a little more like, let's call it $1,600 a month. And obviously that's going to impact my numbers as well. And if that's going to be my strategy, I factor this in ahead of time so that I know exactly what my cash flow would look like after the refinance, to know if it's going to be a viable option for me. So anyway, I won't get too complicated in this for you guys. It's supposed to be the napkin, super, super simple analysis. So remember that if you renovate rundown homes, negative cash flow could be okay if you're very confident in what your new market rent will be. You're going to cash flow, you're okay. But if you're a turnkey investor and you're getting negative cash flow, you want to maybe definitely consider a different investment. Something else to think about too is your cap rate. This is basically taking the performance of the purchase price today against what your net annual income is. Now, your net annual income does not actually encompass your debt. So that's why you have to be very, very careful. I rarely use cap rates because usually they're for prices of properties that have been purchased many, many years ago. The debt ratio is much lower and they're not factoring that into the future cost. So even though it could be, a 7% cap rate today, maybe they bought the property in the 90s. At today's mortgage for the value, it could have a cap rate of 3%. So this is definitely something to take with a grain of salt, but it is something quick that you can do on a napkin, again, to see if you're getting like a decent deal. So if we use this as our example, we're going to take our net annual income. So that means that we're going to just scratch the mortgage, and it's going to be this less this. So it's actually, I think it comes out to $1,330 per month. That's our net annual, or that's our net monthly income, which then translates into $15,960 annually. Then we divide it by the purchase price, which is $400,000, and we get a cap rate of just shy of 4%. It's not a great cap rate. Most people try to look for at least a cap rate of around like 5 to 6%. But to be fair, finding a cap rate of 5 to 6 to 7% in the GTA is almost impossible. And I would probably say that most people that say they have a cap rate of 7% are fudging the number somewhere, or they're really not being conservative in their valuation. So if we look at this cash flow and we're looking at this cap rate, overall, we'd probably say, nah, it's just maybe not worth our time. The caveat is if you're pretty sure that, it's run down and you can significantly increase the market rent, you could make this a viable option. But I would say that's a little more advanced, and you really, really need to understand how devalued the house is. Like, how run down is it? What do you really know the market rents? Talk to realtors, talk to other investors in the market. Make sure you understand the numbers very clearly before you do something like that. So this is the method, guys, that I use every single day myself. It's not just something, random. This is something I use absolutely every single day. So I highly recommend if you're first getting started, you want to do some practice, test it out, use it. You can do some tests, go on MLS, go on realtor.ca, pull up a couple properties and definitely practice and get a feel for this when you do get a property. And again, don't be afraid to dig into the market a little bit more and see if you can improve this cash flow in a modest way. Otherwise, I'd be a little leery about anything with negative cash flow. All right, guys, thanks so much for tuning into my channel. Again, if you love the content, you want to see more, click below and hit subscribe. Till next time, guys. Bye. Hey guys, thanks so much for tuning into my channel. I really hope that you enjoyed today's video. If you're looking for even more amazing content on real estate investing, make sure to hit that subscribe button. I'm going to be releasing amazing videos every single week, so you won't want to miss it. If you want to learn more about working with me and what I do, make sure to check out my website as well. Bye guys.